And welcome back. Thank you everyone for joining us in today's video. Of course, as you guys can see, I have Jim Block again, the founder of Revest Homes, which is the brokerage that I actually hang my license with. But today's video is going to be all about how do you know whether or not it's a good time to refinance or not, given that rates have decreased so much over the past 1 month. If you have a 8% rate or you have a adjustable rate mortgage, now you may want to consider potentially doing a refinance on your mortgage. And of course, if you have debt to pay off as well. So welcome, Jim. Thank you for joining us today.
Thanks for having me on again, Jason. Always great to see you. And thanks to your audience for watching.
Yeah, absolutely. So yeah, I get a lot of questions regarding whether or not people should refinance or not. The last video we posted last week was about, in general, what are you looking at? How does a refinance work? In today's video, we're going to talk about more or less more details regarding certain things that have to happen or to be triggered in order to actually qualify for a refinance. So maybe you want to talk about that, Jim, like those qualifications that we were talking about earlier.
Absolutely. So everyone should not refinance. It all depends on your goals and objectives. We mentioned last time, it's important to think about both short-term and long-term goals that you have. And no matter what you do on a refinance, there are certain net tangible benefits that you as a consumer have to have in order to refinance. Lowering your payment by $3 a month is not one of those things. So we want to make sure that it's a benefit to you and create a custom solution. So we always want to focus on those reasons to refinance.
Yeah, absolutely. And those are all done to really protect the consumer. So back in pre-2010, there was a lot of untrustworthy loan officers who are basically just refinancing just to get paid, which may not necessarily been in the best interest of the consumer. So based on the Dodd-Frank Act that was passed in 2010 after the fallout of the Great Recession, this is one of those guidelines that were passed, which is a safeguard for consumers. So there's some certain things that have to be in place in order for someone to have this benefit of doing a refinance, is what basically Jim's talking about.
That's correct. And again, this first video we're doing is really to explain those 7 things that you can do and the ways to look at refinancing. I have a really good document I can share with you now if you'd like to see it, to explain what those things look like, to be able to see that.
Before we talk about this document, I want to say too that Jim and I are going to be talking about very specific videos regarding if you have an FHA loan, conventional, or a VA loan, how does a refinance work? So stay tuned for those videos, which will be posted in the coming days. I just want to mention that because we're going to be talking about loan specific videos regarding refinances. So go ahead, Jim, take it away.
Yeah, so what's important, this is a document that's prepared by a lender when they look to refinance a client. You will see that the purpose of this document is to evaluate the tangible net benefit to the customer or client. If you look at the bottom of this document, you'll see that there are about 7 different reasons why you can be approved to do a refinance. And we'll just go through that list below to get a good idea as to if it makes sense to do or not. These 7 items are right below under the boxes you can see on the bottom of this document. So the first one, which is the most important one, would be the new monthly payment is lower than the current monthly payment. That one makes sense. The second one is the new interest rate will be lower than the current interest rate. That also makes sense. Next one, the client will receive cash in excess of the costs and fees of refinancing. So for example, if they're doing a cash out refinance, like you see in this example, if you look at the interest rate, it's 4.99 is the example, and that's the same rate as the previous loan rate. But if you look also that they are taking cash out, ironically, it looks like the loan balance is less than the original balance. Well, we don't know if someone has a first loan or second loan. All we know is that they're taking cash out. The fourth option is around changing from an adjustable rate mortgage or ARM to a fixed mortgage. Whenever you have a change from a variable rate loan to a fixed loan, it does not need to have a lower interest rate. the rate can actually be higher.
Hmm.
Reason why is it's creating a more solid and conservative approach to financing. The next one has to do with the mortgage amortization period going lower than the original amortization period. So for example, you may have the same rate on a 30-year fixed and decide to refinance to a 20-year fixed or a 15-year fixed or a 10-year fixed. Those things are also tangible net benefits to the client. They're paying off their debt sooner and having less interest over that period of time. The other category is around monthly liabilities of the payoff items are greater than the current payment. So for example, if you have student loan debts, credit card debts, car loan debts, other debts, you can refinance those debts as long as those payoff items give you a smaller payment compared to what that other debt was. There's another category called other. These would be things like compensating factors. Maybe there's a family emergency. Maybe you want to borrow money for a renovation loan. Those other factors are labeled as other, and it is case by case by the lender to approve them. So you can see that there are several ways to establish a tangible net benefit to the client to make sure that it's a benefit for them, not just for the bank or the loan officer involved.
All good, and these all great safeguards. I mean, it makes sense that why would you want to refinance if your payment's higher? I mean, these are all things basically like, hey, if these things apply, then you may want to consider doing a refi. Otherwise, it may not make sense, and you won't even allow it, right? If you have a Fannie Mae or Freddie Mac refinance, if these things don't apply, then you can't even do a refinance. Is that right?
That's exactly right. So we want to look at these things when we're helping a client make a good decision. So it's first of all and foremost about the objectives of the client to make sure that they have their own short-term or long-term approach to financing. We can provide those options and solutions, and then we have to make sure that it fits the tangible net benefit to that consumer or client to make sure that it makes sense.
Thanks for that, Jim. And so I guess like maybe we should kind of talk about in general as well, some reasons why you should not refinance, but also some reasons you may want to consider doing a refi as well.
Absolutely. So I would not refinance if the cost to refinance took longer to recuperate than the savings. So again, if it costs $20,000 to refinance and you're going to save $100 a month, it is not worth saving the money to spend money to buy it down. It all comes down to your, again, objectives. If you're planning to sell your property in the next 3 to 4 years, you're probably better off doing nothing unless you can save money from day one on a refinance. Another reason why you may not want to refinance a property is, again, if you're going to be selling the property and or doing some other financing down the road. Maybe you're doing a renovation loan. Maybe you're doing something that you can pay off this loan faster or don't need a loan. So just because you can does not mean you should a lot of times. So evaluate that and talk to your local professionals, your trusted loan officer, your financial planner, your wealth advisor, your CPA, to make sure that you have good understandings of, is it worth spending money to save money, and what is that break even to do that?
Right. Absolutely. One thing a lot too regarding that is that once you do a refinance, you're basically getting a brand new loan. So a brand new amortization schedule as well. So if you have your loan that's very close to being paid off, and otherwise financially you're okay, you don't have like massive amount of credit card debt or a HELOC loan, for example, then it may not make sense as well, because getting a new loan, you're going to pay a lot more interest in the upfront or in the early stages of your loan compared to the later stages. And if you have a loan which was a 30-year fix in your last 5 years, the vast majority of your payment is likely going to your principal and not towards interest as well.
And remember, your loan restarts, and therefore that amortization schedule, which is the schedule over 30 years or whatever the term is heavily weighted to be an interest element in the beginning of that program. We'll show that in one of our next videos and one of our examples of either a VA or FHA or conventional refinance, that schedule over time, you're paying more principal as your loan gets closer to when it's due. The reason why? Banks want to make interest off their loan balance. So you're paying all of that risk premium more towards the front of the loan so that that bank is making interest that they can then reinvest in other loans.
Got it. Got it. Makes sense. Okay, and then maybe some talking points about why would now be a good time to refinance as well.
Absolutely.
And
So,
let me say too, because when we made this first video too, I mean, I got a couple of comments regarding that people think that rates are going to go down further, so now is a horrible time to refinance. And my response to those people, and some people were saying that the labor market's, showing signs of cracks, which I've been talking about on the channel for a little bit now, is that, in my opinion, that wouldn't be a reason to not refinance, because if you want to refinance your loan, you have to qualify for a new loan. So the worst time to try to refinance is after you lose your job. And so if you want to err on the side of it being conservative, if you're worried about losing your job, then you may have a lot of trouble getting a refinance when you don't even have any income coming in. But yeah, go ahead, Jim.
So on any loan that we do, there is no prepayment penalty, which means you can refinance at any period in time. Again, it has to make sense to refinance. So my approach has always been, if I can save money today, it's worth saving money. Again, I may lose my job. I may have a credit issue where I no longer qualify. Maybe there's a hardship or life event. Maybe the house value goes down. Probably not likely, but if the house value goes down, the risk for that loan goes up. So maybe I can't get the same rates. Either way I look at it is it's a gift to a lot of people to be able to save money right now in these time frames. And again, if you can, if it makes sense down the road again, you can always do it again. A strategy that we do a lot on our side, we will lock for 60 days, which means transaction time frame, we have a lock for 60 days. We can get these done in like 2 to 3 weeks. We're really efficient. But what's nice about that longer lock period, we can study the market conditions and the trends of interest rates to see if it makes sense to go with a no-cost option or pay a lot of money to buy the rate as low as possible. So in that window of refinancing, we can follow the market trends to make sure that we have the best solution at the end. It's almost like an insurance lock. We're locking for 60 days. We're getting your loan approved. And at the very end, you can decide again if you want to go with a no cost or a cost option, depending on what the market conditions are at day 50 versus day 1 when you start the process. So it gives people peace of mind that they have a guaranteed amount of interest that they're going to save, but they can shift and pivot if they decide that their strategy is looking better one way or the other.
Yeah, and then on top of that too, you mentioned in our previous video that Revest Loans has a program in which if rates decrease to a certain level, then you can get that lower rate. So if you locked in for 60 days, then you could potentially get it that lower rate if rates were decreasing. So can you talk about that real quickly?
Absolutely. And that's what's called a rate renegotiation. We're lucky here at Revest to have great partners and lender partners. As a mortgage broker, we're able to pivot and shift our loans to different lenders also. So if there's one lender that's standing out with the most optimal pricing or best service and best product for our client, that's where we can go. We can also shift and pivot that to another lender if there's someone that comes in and offers something that's way better for our clients. There is not an advantage that we have to go with one lender or the other. We get the same margin in whatever we do, but the benefit is to the customer and client, which I love. So it's very easy on every given day to see transparently where the best solution is for our clients.
Yeah, and that's totally different compared to like walking into a bank and they have their own loan products, and that's like the only product offerings they have. So how would you know if you're getting the best rate or not?
Exactly. And again, the best rate for you, Jason, is what's right for your objectives. Again, it's not the lowest rate necessarily. It's not the cheapest cost necessarily. It really depends on your custom approach. And that's what I love about this job and our career path that we're both on here, is that the fact that everyone's goals are completely different. and unique. And that makes it exciting every day to do our job.
Yeah, for sure. I mean, way better than working at Citibank or I was an insurance salesman basically for a couple of years as well. So Jim and I both have like a securities background as well. Series 7, 66. So
too many licenses. Yeah. Too many acronyms.
know, right?
Yeah. Every letter of the alphabet and every number that exists probably.
So awesome.
But it's an exciting time. Yeah. It's an exciting time to look at refinancing. What I love about this, with rates going lower, it gives everybody the ability to have a higher buying purchasing power or refinancing power, right? Every percent that goes down in rate, it's about a 10 to 11% increase in buying power or savings of cost to borrow money. So consumer confidence gets stronger as rates go lower because people can afford to buy more or save more on a refinance. So I love markets like this where we can help people. And if you bought a house and have a rate of 6.5% and we get you 1% lower in savings, that could be a new barbecue. That could be saving money for a college savings plan. That could be vacations. That could be a couple nights out to dinner, whatever those things are that are important to our clients. So I love when the markets shift like this. And my belief is that I wouldn't want to wait to go for the lowest rate. It's very hard to catch a falling knife, as they say. So why not save money sooner than later and know that if you can refinance down the road again, fantastic. If it makes sense to do it, it meets your goals, do it again. But it has to meet that net tangible benefit to you. And the lenders have to make sure they evaluate that. So there are safety guards in place to make sure it makes sense.
Yeah, absolutely. For anyone who reaches out to us, that's something we cover in our conversations, and we can help you kind of determine your break-even point, et cetera, comparing your current payment compared to the new housing payment as well. So I'll provide a link in the video description below for Jim's calendar. Generally, we do these videos to provide value for you guys. And last time, a lot of people reached out to us. So the calls we have with people will be just with Jim and I. I'll provide a link in the video description below. And also stay tuned for future videos. If you have a conventional loan, a VA loan, or an FHA loan, what does it look like to do a refinance? Because the process is a little bit different. So Jim, thank you for joining us. I really appreciate your time.
Thank you. And be ready to drink a lot of coffee because it's going to be busy for the next couple of months here, I think. And what exciting news to have. Little end of summer treat for everybody. Hopefully they can take advantage of it. And please make sure that you see the states we're licensed in also on Jason's posts so you can know who we can help, because we want to be fair to everybody that we can help in our licensed states we're active in.
Yeah, absolutely. Good point. We're not licensed in all 50 states. So appreciate that, Jim. All right, awesome. Thank you everyone for watching today's video. Please check out those links in the video description below. Hope you have an awesome day and look forward to seeing you on the next video.